I would like to welcome our moderator for this evening's conversation, Dr. Irene Kim, Associate Professor and Director of Finance for the Busch School of Business. Over to you, Irene.
Thank you so much, Josephine. We are so excited to have you here. We're so glad you could make it this evening. Wow, what a crazy year it's been, right? So we could all probably use a nice cleansing breath like we're at yoga, right? We're so happy to see 2021 roll in. We probably start out this year with our normal tax planning, estate planning, charitable giving planning, and of course that was all upended by the pandemic. So why are we here today? We want to make sure you understand what specifically you need to know for your end, and then a little bit going forward when President-elect Biden joins the office. So we're going to frame our discussion around 3 different events. One is the Secure Act, one is this CARES Act, and one is the new coming President Biden. So I'd really like to welcome our panelists. First of all, we have Lynn Gallmer. She is the Senior Technical Consultant for the Stelter Company. Stelter is a leading source for gift planning marketing for the nonprofit community. Welcome, Lynn. Next up, Parker Griffin is Vice President of Wealth Management, Financial Advisor, and Senior Portfolio Manager with the Concord Point Group at Morgan Stanley. He's also an adjunct professor here at Catholic University's Columbus School of Law and is an alumnus of the law school. Thank you so much for joining us, Parker. And Larry Lipoff is Director of Trust and Estate Tax Services for CohnReznick. CohnReznick is a leading advisory, assurance, and tax firm with offices nationwide. Welcome so much, Larry. Okay, so let's jump in, right? The first thing we'd like to talk about is the Secure Act. What does the Secure Act stand for? Setting every community up for retirement enhancement. So this was signed into law in very late 2019. So maybe it went sort of unnoticed, but it has huge implications for retirement planning. The most broad sweeping changes for retirement planning since 2006. So it has implications for so many different people: employers, employees, retirees, even students. So let's start with this. And Lynn, could you start us off by walking us through the 3 main changes affected by the Secure Act?
Yes, thanks, Irene. So yes, as they relate to charitable giving, there were 3 main changes that we want you to know about. The first one, it removes the age restrictions on IRA contributions. And what that means is that under old law, you could not contribute to your IRA past the age of 70 and a half. So, but now you can. And so if you want to contribute to your IRA past the age of 70 and a half, you can certainly do so. And the reason behind this change and the next one, changes of age for required minimum distributions, is because people are living longer. So Congress wanted to ensure that the funds are going to be available as people are living longer. So the new required minimum distribution age is 72. It was 70 and a half. Now, if you turn 70 and a half prior to January 1st of 2020, you're kind of grandfathered in and you will continue on with your required minimum distributions. But otherwise, if you turn 70 and a half after January 1st of 2020, then you just can wait till your age of 72. The third one is probably have the most implications and probably causes most concern for donors I speak with, and that's the elimination of the stretch IRA for most non-spousal beneficiaries. And what that means is that in prior law, if my father, for example, named me as beneficiary, I could stretch out, when he passed, I could stretch out the distributions over my life expectancy, over my lifetime. But now beneficiaries have to take it out within 10 years. Now they can take it out a little bit each year. They can take it all in the 10th year, but they will have to take it out all within 10 years. And that creates some opportunities for those who are charitably minded, who would prefer to stretch those distributions out back to a life expectancy by some life income gifts like CGAs and charitable remainder trusts.
Okay, great, Lynn. Thank you so much. How about Parker? How has the Secure Act impacted your clients, and what strategies have you recommended to them?
Sure. Well, first of all, thanks for having me. It's a pleasure to be talking with all of you. To follow on what Lynn was saying, I would say one of the biggest changes is the transition away from traditional thinking about IRAs. We have generally talked with clients about IRAs as either a live-on asset or a leave-on asset. You live on that asset during your lifetime, you take distributions for yourself, or you leave it on for your kids. As Lynn mentioned, with the stretch IRA effectively being eliminated for non-spousal beneficiaries, we pivoted away from the live-on, leave-on to talking more about legacy, and not just within the family, but for institutions. Clients realize that they're paying the taxes now, or their children will be paying them later. The tax regime is simply less appealing. So many clients are accelerating their gifting, giving institutions via the qualified charitable distribution from the IRA. That's number one. So more qualified charitable distributions. The second thing that we're seeing more frequently is the gifting of appreciated securities. One of the easiest ways to make a gift is by donating appreciated securities. Think about it this way. If you are able to gift appreciated stock, the institution receiving that stock effectively gets 20% more. The reason for that is the top capital gains rate is 20%. Rather than selling the stock, paying 20%, 15 or 20% in long-term capital gains, then writing a check, you can gift the stock directly to the organization. As long as you've held the stock for more than a year, you will also be allowed to take the deduction for making that type of a gift. We've had a very big run up in the market. It may not feel that way, but it's true. The S&P 500 is up 14%. The NASDAQ is up 42. Tech is up 36. Energy is down 36. Somewhere in your portfolio, you probably have a position that either has run up quite significantly this year, or may have even fallen off, that you just don't want to be a part of your financial plan anymore. And that may be the easiest type of position to pick off and look to make a donation. So those are the two primary areas that we've been talking about, is the qualified charitable distributions and gifting of appreciated securities.
Wonderful. And how about over to you, Larry? Have your clients noticed any impacts of the Secure Act, and have you recommended any strategies to them?
Yes. So normally a charitable remainder trust is not as effective in historically low interest rates. However, due to point 3 of eliminating the stretch, clients have considered setting up what's called the net income makeup charitable remainder unit trust. Most estate planning strategies have an acronym, so it's known as an NIMCRUT, which eliminates the elimination of the stretch. In other words, the assets from the pension plan, the IRA, go into the NIMCRUT, and then there's payment over a period of time that could recreate a stretch. Now, what goes to charity is almost like a replacement of what would go to the government in terms of taxes. When you run the numbers, you see that internal appreciation of the NIMCRUT assets that had been in the IRA. So bottom line, one may be facing an elimination stretch that they've been planning for. One may want to consider with their tax advisors, and obviously with their plan giving team, that maybe a NIMCRUT would be helpful to reset what they had built into their plans with a stretch IRA.
Great. So that is our summary of the Secure Act and how it might impact you. Obviously, it was huge legislation to try to encourage more retirement savings, but there are a lot of dials that have been tweaked. And similarly, the CARES Act then came into place in April. And so, of course, this was in response to huge economic downturn, huge unemployment, right, caused by the pandemic. So they launched the CARES Act, which stands for Coronavirus Aid, Relief, and Economic Security Act. And this was enacted by the federal government. It's the largest fiscal stimulus in modern history. So there were three big changes in the CARES Act. One, of course, let's get cash, let's get money back into the economy, right? So they gave households cash payments so that we would improve consumer spending. Number two is it provided liquidity to small and medium-sized firms, right? Keep the employees on the payroll through the payroll protection plan. And three, of course, was for the unemployed, right? They extended the safety net to millions of Americans by temporarily expanding the unemployment insurance system. But what we need to know is that the CARES Act had, similarly to the Secure Act, implications for charitable giving and retirement planning, many of which are actually expiring in a few weeks. So Lynn, let's send it over to you. Could you explain to us the three main changes for the CARES Act and when this legislation will summit or expire?
Sure. So thank you, Irene. Yes, so once again, three main changes for the CARES Act now. So the first thing is that it's suspended required minimum distributions. So once an individual reaches either 70.5 or 72 under the Secure Act, you have to take required minimum distributions. But given that the stock market took a huge downturn late March, early April timeframe, Congress decided to kind of give a little reprieve because the required minimum distributions are determined on January 1st of like what would have been this year. And of course, the stock market was a lot higher than it was, let's say, in end of March, early April. So they decided to give a little reprieve so that to give time for that stock market to come back, and sure enough, it did. So I do expect required minimum distributions to return for 2021. I don't anticipate Congress to continue that provision, so it will expire at the end of this year. The next one creates a new universal charitable deduction, and this one is that for those who take the standard deduction, which is about 87 to 90% of current taxpayers who take the standard deduction out, can deduct up to $300 of cash gifts to charities. And so this is an above the line deduction for those taking the standard deduction. And you may think, oh, $300, is that gonna, really make an impact? But what happens if, half of all the alumni make a $300 gift, or parents or grandparents of the students at Catholic University? What happens if all of them make $300 gifts? And let's say it doubles because of a company match. That's a huge impact for organizations. So really consider, if you have not done this $300 contribution yet, do so by the end of the year. This is expiring, and I don't see that it returning after January 1st. The final one is it lists the cap on cash contributions for those who itemize. So if you are somebody who itemizes their deductions, you can now make cash gifts to nonprofit organizations up to 100% of your AGI. If you work the numbers correctly, you can actually make a sufficiently large gift to a nonprofit and deduct that and pay no tax for 2020. And I've seen that happening in a couple situations. So, so think about that as you think about charitable giving in these final few weeks of the year. Irene?
Great, thanks, Lynn. So of course, as Lynn mentioned, we've seen huge market volatility. I know I had to put some sunglasses on to look at all the red in my retirement account. So we have that, plus we have the CARES Act changes. Parker, I'm sure you know that your clients were quite concerned as well. One interesting thing I want to note is that most of the time the business and economic cycle have historically mattered more than actually who's in the Oval Office. So Parker, what are you advising to your clients in terms of strategy?
Yeah, good question. We have a process where we look at every piece of the financial picture. It's like a puzzle. And we're trying to help clients create predictability. What can the money do for you now? What can the money do for the next generation? That next generation definitely involves family, but it may also involve institutions. In terms of planning, we like to quote Lewis Carroll, which is, if you don't know where you're going, any road can take you there. And particularly when it comes to philanthropic planning, we are encouraging folks to sit down, develop a plan. When we talk about philanthropy, in the context of planning, it's not just about tax efficiency. Of course, we want to encourage people to do this intelligently, as tax efficiently as possible, to make good decisions. But it's also about understanding what the institution does, the institution that you would like to give to. What are its core values? How do you want to support the mission? If philanthropy is important to you, it should be a part of your plan. What amount do you give? How do you give? Do you make several smaller gifts to multiple institutions? Do you make larger, more significant gifts to fewer institutions? We generally encourage larger gifts because that allows you to focus your energy on helping create the type of change that you would like to see in the institution. If you could flip to that slide about business cycles, that would be great. So when we take a look at this with clients and we're talking about planning, and by the way, this is not a political discussion. I am very far away from that. I am agnostic when it comes to that, and helps keep the peace at Thanksgiving. So this is not a commentary about any type of policy. We're trying to demonstrate that when you look at the two of the business cycle and who is in charge, whether it's red or blue, as it were, the business cycle will continue. And that your plan does not necessarily need to be beholden to who's in the White House, who's in control of the Senate. Those things matter, but not always as much as we think. So again, we want to be making intelligent decisions, but we want to be making them in the longer term, not shorter term. And that's generally where we start, Irene, in terms of counseling clients.
Great, thank you so much. So that's the CARES Act. As Lynn mentioned, some things are going away, and she doesn't think they're returning for after January 1. But let's get political for a second, right? So let's talk about President-elect Biden, right? So of course, he has proposed tax policies coming in. He wants to raise capital gains and estate taxes and changing the taxation of capital assets upon death. So we of course have this Georgia runoff that's coming in January, and that will determine who has control in the Senate, right? So there is a lot of uncertainty. Whether Biden can pass his changes through and make them into law largely depends on who runs the Senate. So we don't really know what's going to happen for sure. But we can start to read the tea leaves a little, right? We can think about, what do these proposed changes mean for you? What are the implications of what he's thinking about? So let's go over to Larry. Larry, walk us through the impact of the changes and who would be impacted exactly.
Thank you, Irene. What I'd like to possibly focus in on, which has, majority of the impact on my practice, has really been the thought that the lifetime exclusion for gifts and estates, which now is in excess of $11.5 million per person. So you're talking about $23 million per couple, because we look at a couple as an economic unit, and a top marginal tax rate of 40%. The discussion has been that let's say a Democratic sweep would lead to a gift tax lifetime exclusion of being $1 million, that the estate tax annual lifetime exemption would be $3 or $3.5 million, that there would be, instead of a top marginal rate of 40% to 45%, or what was traditional for many years, 55%. So with that in mind, many of my clients are looking to do proactive planning in December. Now, I realize that not everyone is doing planning because they're concerned about a $23 million lifetime exemption for a couple going away. But if one could bear with me for those that are. So one of the things that people look to is saying, hey, I want to take advantage. And if they don't have that much, excuse me, but they want to do some planning, they consider spousal access lifetime trusts, which are SLATs. So a SLAT would basically be set up by both spouses, where the trusts are going to be slightly different between the two, where one spouse makes the beneficiary their spouse, children, and usually future generations as well. In certain states, a trust could last forever. Others, it could be 300, 360 years, and some, based on English common law, still look about 90 years. So why are we doing this? So people want to use their lifetime exclusion, but they're concerned that they may be doing great planning for their kids and grandkids and future generations. However, they may need the funds. So the thought is that if a spouse is a beneficiary, so the trust and the family needs the money, the senior generation, that a transfer can be made on behalf of a spouse who may need to buy a new house or do something that will bring along their spouse, the original transferor, to the SLAT. So that's one thing. Another thing has come up that people say, you know what, I'd like to contribute business assets and really portions of businesses and take discounts because the measure of value is what a hypothetical willing buyer and willing seller would come to a decision of value with reasonable information about facts, with no compulsion to buy and sell. So we'll often do that as a way to move assets, but not impact necessarily liquidity or control if it's structured properly. A final thing is that looking at this, they may look at life insurance as a very nice vehicle, because one of the other proposals is to raise income taxes. And using life insurance, the internal, if it's properly structured, the internal growth of a life insurance policy, the cash surrender value, will not be subject to income tax. There can be loans against the growth of the cash surrender value that will be tax-free. And the death benefit, again, if properly structured, will not be subject to income tax. There's another thing that's in the winds of, hey, consideration of eliminating one of the basics of estate planning, which has been that someone passes away and there's going to be a step up in value. That if someone bought an asset for, let's say, $100,000 and now it's worth $1 million and they pass away, that for going forward for future generations, whoever is going to be the beneficiary, the tax base is going to be $1 million. And it's going to be automatically long-term capital gain if it's sold at a gain or loss. And that could even be someone passes away the next day, if it's possible, one needs to have access to the funds, but leaving that aside, that day it went up $100,000, so it went from $1 million to $1,100,000. That's going to be a long-term capital gain if the asset sold, even though it was only held really 2 days, one day before the decedent passed away, and the next day it sold. 2 days, that's long-term based on the code. The thought from the Biden campaign has been to eliminate the step up in value. So having transferred assets, the closely held business, and what's called a grant to a trust, really have time for it now, but it's basically transactions between a person and their trust that they're the grantor of. Is not going to be subject to income tax. So it may well be that normally one would wait till put an asset in, let it appreciate in value, and when it comes to a short life expectancy to flip assets, one that has high value, high basis, put it into the trust, take back something with low basis, but their equivalent value, and to pass away and obtain that step up in value. That concern of not having that baseline plan that everyone in the estate planning field has really worked with may be an issue to consider life insurance, because the asset will come out as cash in most cases, just about every case, and then you don't have to worry about step up in basis, and you can work from there. There's many more things to discuss, and I'm sure my co-panelists could really add to that, which I've tried to lay out.
Thank you. So Lynn, let's go over to you. Do you have any thoughts on Biden's proposed tax changes?
Yeah, thank you, Irene. So a couple things. I would have to say the step up in basis in the event that, and just to be clear, that typically right now, if a child were to inherit a stock, let's say the parent paid $25 a share for that stock, it's now worth $50 a share. That child inherits it at $50 a share if that's the price on the date of death. But with Biden's plan, it's still $25. They don't get that step up in basis. So what I think what we'll see as far as charitable giving goes is that since there won't be that appreciation to give to the child, we may be seeing some more gifts of appreciated assets to nonprofits. And so I think we'll be seeing that and individuals who are charitably minded explore that opportunity. As far as the estate tax goes, so currently, Larry was correct. It's a little over 11.5 million now. With Biden's plan, we're looking at maybe like 3.5 million. And with the current taxes, I saw a shift in charitable giving from charitable giving at death to charitable giving during life, so that they could take the income tax deduction on any gifts. If that estate tax deduction goes back down to, let's say about $3.5 million, I think we'll see a shift back to maybe some more planning at death. So let's say gifts in people's wills or trusts, or beneficiary designations like life insurance or retirement plans. So I think we'll see a shift there. I've always thought of the estate tax as a volunteer tax. If you give a sufficient amount enough to charity, you don't have to pay estate tax. So it doesn't matter if it's 45% or 55%. If you figure out where you're at, you won't have to pay it if you give a sufficient amount to charity. So I think we're going to see some shifting of the way people do things as far as charity goes, and really look at where they can make the most impact. Retirement plan assets, you know, if they're still the most highly taxed assets out there. And so when given to those heirs, they're going to be taxed at their ordinary income tax rate. But if you give those assets to charity, guess what? No tax. So really, I think people are going to be really looking at ways that they can be charitable and support their heirs as well.
Great. Those are great points about sort of changing your strategy of who gets what when you're giving. Thank you so much. So Parker, how about you? Do you have any thoughts on Biden's proposed changes?
I do. If we could go back a couple of slides, I did want to hear Larry's thoughts before I jumped in, Larry Inlet, to the donor advised funds, because I think what they've both expressed, and it just has been sort of clarified, is that there's a lot of uncertainty out there. That if anything, the landscape is murky from a tax perspective. We know what Biden has proposed. You can go on the website and it's been in the press, but the questions remain about what will actually transpire in the next 6 to 18 months. One of the vehicles that we have seen used increasingly are donor advised funds. A donor advised fund basically allows an individual to make a tax deductible contribution in the current year, and then they can allocate those contributions to nonprofit organizations over time. They can spread those distributions out over multiple years. So from a planning perspective, tax-wise, it may be advantageous for somebody to put in the lump sum in, let's say, 2020 or 2021, receive the deduction in that year, and then see those assets distributed over time. The donor has a degree of control about where those assets are going to be distributed in terms of to the nonprofit. They're going to be able to get the charitable deduction up front. They're going to watch those assets grow tax-free inside of the donor advised fund. So I think it can be a great solution for people that are trying to navigate this murkiness, would like to do something now, but there can also be a longer term element to it. That may be a good fit, and that's something that we're discussing with a lot of clients.
Wonderful. So we've talked about, you know, the Secure Act, the CARES Act, the Biden effects. It looks like, you know, higher taxes are coming, elimination of the step up in basis, and beneficial legislation, which could expire or probably will expire in just a few weeks. So I want to get some sort of key messages from each of the panelists. So let's start with Lynn. What are the key messages you want everyone to know?
Yeah, so whether we have a different tax plan or not, there's just some really nice ways to take advantage of some income tax deductions and make a charitable gift. Irene, if we could go back to the qualified charitable distribution, I do want to talk about that a little bit. There's a slide there. Qualified charitable distributions are something that's been available for a while now. I do not see them going away, so I do believe that they'll continue. Some of you may have heard of. They're also called IRA charitable rollovers, so you may have heard them with different names. But what it is if you are 70 and a half or older, you can take your IRA and make a distribution directly to a qualified charity. It can be any amount up to $100,000 per year. And it can't be actually to a supporting organization or a donor advised fund. But what many individuals do here is this is how they create their pattern of giving. They will take their IRAs and use it as a means to make their gifts. So let's say, for example, you are 72. You have to take your required minimum distribution next year. So let's go into 2021. You have to take your minimum distribution. You maybe don't need the income, or if you take the distribution, it might send you into a higher tax bracket. And you're thinking, how can I take my required minimum distribution but not be penalized from a tax perspective? Well, if you're charitable, what you can do is direct up to $100,000 per year to not only one charity, it could be multiple charities, but all adding up to 100,000. So if you wanted to give $10,000 to 10 charities or something like that. But when you give these gifts to charity, you don't recognize it as income. It goes directly to the charity, nor can you take an income tax deduction. But this is just a really great gift that I have seen used many, many times. Now, some individuals decided to kind of take a break from this gift in 2020 because they could not use their RMD. So what some are doing is actually kind of making up for that in 2021. So when that RMD returns on January 1, they're making a gift, or they're at least planning to, making a gift out of their IRA, taking advantage of qualified charitable distributions in the beginning of the year to make up for 2020. And then at the end of the year, continue on and make a gift for 2021. So just again, it's only for those 70 and a half and older, but if you have an IRA, and this does not include like a 401k or a 403b, it has to be an IRA. Just a really nice way to give to charity. I also did want to mention something called a charitable gift annuity. And we've seen quite a few individuals use this because of the market fluctuations that we've seen this year. So a charitable gift annuity is where you would give cash or appreciated assets to a nonprofit organization like Catholic University. And then in return, you get an annuity for your lifetime. And it could be for you or you and your spouse, or it could be for a parent or a sibling. So the rates are really good. They're much higher than what you would get with like a CD or a money market or something like that. So you get a lifetime stream of income that's secured, and it will never change. So you can certainly depend on it, and it will never fluctuate. So the markets could go up, it could go down, they could go sideways, whatever the case is, you will get a secure income. And we've seen a lot of people go in this direction this year because there's been so much uncertainty. And so for those who are charitable minded, who want to enhance their retirement income, we've also seen many donors going this route to do a CGA. So something you certainly want to talk with our friends at Catholic University or another nonprofit about doing. Okay.
Great, thank you, Lynn.
Mm-hmm.
How about you, Parker? Are there some key messages you'd like people to go away with?
Yes, I think the first is have a plan. My 10-year-old was in the garage the other day. I think he was trying to build a time machine. I'm not exactly sure what it was, but I just heard a lot of hammering, and I came out and there was a couple nails stuck in a board, and that was about as far as he got. He had an idea of something he wanted to try. He took one tool and he went for it. Didn't work out particularly well for him. Having a project in front of you, something that you're trying to accomplish, and then using the right tools for the job is extremely important. And partly what we're trying to communicate is there are many different types of tools that are available, but having that plan about how you would like to give, how much you would like to give, where you would like to give, and connecting all those pieces, and then using the various tools that have been talked about is extremely important in terms of the efficacy of the plan. So after having a plan, I would say that the two primary vehicles that I would encourage, because they They can be done quickly and easily, are gifting appreciated securities and utilizing donor-advised funds. Again, appreciated securities, the charity, the institution is going to get more because you're not going to have to write that check to the tax man to pay capital gains and then write the check to the charity. So the institution is going to get more. It's a more intelligent, efficient way to do it. And a donor-advised fund may be a great solution in terms of how you're trying to structure something. Could be more tax efficient up front, but you also get to see the impact of that gift over time and having the ability to be a bit more involved with professional managers managing the assets, and then you get to help direct where those funds go. Can be a very gratifying experience. So I would say have a plan, look at gifting appreciated securities, and look at donor-advised funds.
Great, thank you, Parker. And how about to you, Larry? What are some key messages you'd like to convey to the audience?
Very much appreciated, and something that really came to mind as we've had the discussion. And that really is the following. I mentioned that a couple has looked at it as an economic unit, really if the surviving spouse is a US citizen. I understand most of the alumni, the friends of the university are generally US persons. So let's just assume that. And, you know, between Lynn and Parker, they've done a tremendous job speaking about different ways of charitable giving. So an issue that's come up a number of times has been the following, and this is lately. Well, let me start off with, interrupt with a sidebar that the estate tax that Lynn said is voluntary is really a theory, an excise tax on the transference of wealth. Whether it's a gift tax, estate tax, it's imposed on the transferor post-mortem, their estate, or their irrevocable trust, or when they make a gift, you know, during life. The gift is imposed to them. If they don't pay it, the recipient has to pay the tax. But generally, that's the way it works. It's different than most countries in the world. Now, when the transfer is made at death, since it's an excise tax on the transference of wealth, the tax is imposed unless it's not going further to a taxable entity. Goes to a surviving US citizen spouse, no tax. Economic unit, couple. If it goes to charity, no estate tax. It hasn't passed wealth to another person other than the US citizen spouse. But what happens if there is a break? There is transfers to children, other loved ones. There's to a spouse and to charity. Now, where does the estate tax get imposed? For many, they would say they want their whatever is going to go to the beneficiaries should pay their share of the tax, because the other portions are not necessarily subject to estate tax, not the money that goes and other assets that go to their surviving US citizen spouse, and not to charity. But if what's called the tax apportionment clause is not properly drafted, and I've seen it recently at times that I've stepped into matters where the estate tax is actually imposed either on the surviving spouse or to charity. So what happens then? If, let's say, it goes to charity and the charity has to pay an estate tax, well, that's going to be less money that goes as a charitable donation to charity, which in its own right increases the estate tax, and what we call is an interrelated calculation. So the more that the estate tax is imposed to surviving spouse, US citizen, or to charity, it could create much more estate tax than one thinks, and the bequest, let's say, to charity is minimized. So what does one have to do? I think one of the biggest things that's hardly ever spoken about is to look at what's called the tax apportionment clause. again, a tax apportionment clause. It's going to say on what element of one's bequest or bequests is the estate tax going to be imposed. One wants to sit down with their professional advisors and their charitable planning advisors to make sure that what they intend is actually going to happen, because if it's stated in a different way, or it's not stated and then it devolves to local state law, there could be a real surprise, not only to the family thinking there's going to be a nice donation, let's say to charity, but also the charity that's awaiting setting up for funds, has a special program, whatever. And as such, the extra time spent sitting down and make sure everything's lined up what one wants when they pass away is very much crucial, and it's becoming more and more an issue today, but hardly anyone's talking about it.
Great, thank you so much. So now I'd like to send it over to Josephine, who will facilitate the Q&A.
Sure. Thank you, Irene. We've had some really good questions. One important question is the estate tax threshold $3.5 million for couples or for individuals? That was mentioned.
So it's currently, I think it's a little over 11.5 million per person, about 23 million per couple. But with the Biden plan, he is considering kind of going back to about the 2009 figures, which would put it at about 3.5 million per person, and then about 7 million per couple. So hopefully that clarifies it.
We have a related question. There's currently significant lobbying by the nonprofit sector for extending and even increasing the charitable deduction for non-itemizers. Is there any hope, even if the Senate maintains a GOP majority in light of a Biden administration, that this might happen? So the question is, do we believe that the lobbying for the increased charitable deduction for non-itemizers might happen under a Biden administration? Get your crystal balls out.
I could take that one again. So, well, I certainly hope so. I have heard that maybe there would be some benefits, tax benefits under the Biden plan for going back and possibly capping charitable deductions for itemizers. So that would be a thought. The other piece of legislation that I've heard would be expanding this universal charitable deduction. So right now, you know, they gave a temporary $300. I have heard a couple of different variances on that. One doubling it, so $600 per person, and actually $1,200 for married couples, or giving a universal charitable deduction for half of what the standard deduction is. So I think that there are a number of tax policies out there to benefit charitable giving. Which one ends up in the final bill? That's for the crystal ball, I guess. But I do think that any tax legislation would be that passed by the Biden administration would be friendly for charitable giving.
Thank you, Lynn. And Larry, this question is for you. A member of our audience saw the slide about life insurance and is wondering, is this a strategy you're recommending to clients at your end?
So I'm wondering if and maybe Josephine, you could help if they're talking about private placement life insurance or regular life insurance, which, slide about life insurance are they really asking about?
Sure, I think it was the initial slide, and the member in the audience didn't specify, but so I'll turn that question around. is there a particular type of life insurance that would be most beneficial, with an awareness of what might happen according to Biden's policies?
Sure. So it's a great question. And, part of crystal ball and some just what might make sense. So to the extent that income tax rates are very likely to increase. So the thought of those with the proper amount of net worth to justify it, which generally would mean $20 million and above. The concept of taking, let's say, $5 million and putting it into a private placement life insurance policy where there's an independent manager, some set up a what's called an insurance dedicated fund to invest those assets in certain investments that are income tax inefficient, but with thoughts of significant growth, and keeping it for the long term will be a way to not just lower income tax, but avoid income tax. Now, the trade-off is that one has to pay a certain amount of fees to the insurance company and to the investment advisor. And then there cannot be what's called investor control. It has to be diversification as well, but investor control means real or implied. But for those that are in that category, spoken to clients recently about considering if they're extremely wealthy people, one case worth a few $100 million, and just about everything they have is planned to go to charity. So why pay income tax? Why not put into a private placement life insurance policy if you get the right investment advisor? And then if one needs the money to borrow it out, no income tax. And when they pass away, the death benefit will presumably go to charity. There'll be basically a bookkeeping entry to reduce the death benefit by the amount that may have been borrowed. Most likely they're going to have separate assets, but that's how it would work. And it becomes a win-win situation. Why pay income tax and why should pay estate tax if you want to benefit charity?
Thank you, Larry. Parker, this question's for you. You talked about donor-advised funds and QCDs. What else are you discussing with your clients at year-end who are interested in making charitable contributions?
Good question. So one of the things to piggyback on what Larry was saying, we do talk about using life insurance, not just at year end, but there are other ways to go about funding a life insurance policy rather than taking the required minimum distribution and giving it to charity, which is one way to do it. If it's not being utilized by the client, they don't really need the income, they can take that and use that to purchase a life insurance policy, naming a charitable institution as a beneficiary. It's not an all or nothing proposition. You do not have to name them to be 100% beneficiary, but that's one way to say, look, I'm not using these assets. What's a way to leverage those dollars? Life insurance is one of the last sort of tax advantage types of investments that remain. And so people are trying to take advantage of that. I would say that's probably the primary vehicle right now.
Great, thanks, Parker. I know we talked a bit about the estate planning thresholds, but this is a little more detailed question. It is, would the loss of step up be for any asset for any estate size? Can you take that, Lynn? If in your words?
Yeah, I believe it is. I'm not positive. I don't know if there's all the details on Biden's plan has been released, but I do believe it would be for, I don't think there's a threshold or anything like that. I think that it would be, just simply, if you leave an asset at death, it would be stepped up at that time.
Terrific, thank you. And I think we have time for just one or two more questions. Here's a question about depreciation. Any news about the special tax on depreciation, for example, of an investment property that usually goes away at death? Who would like to take that?
I'm not sure about that. I'll leave it to Parker or Larry. I'm not sure.
Yeah, not entirely sure either. I'd have to research that one.
So one of the keys, and I haven't heard really anything there, but one of the keys is that we usually talk about depreciation in partnership investments. You know, often real estate investments are done in partnership. And part of it is that not only is there a step up in basis in the partnership holding, but there's a way to make what's called the Section 754 election that allows a step up in basis in the internal assets. And there's allocation rules and all types of details to drill into it. But if one has a 754 election, that traditionally allows in really starting over, hopefully with appreciated property way above the basis, to be the new basis and to take depreciation internal. It works for partnerships. It does not work for S corporations. So again, I don't know I haven't heard any reason that they're going to take away, but if they do away with step up in basis, they're going to wind up also doing away with the practicality of the 754 election, even if it's still in the books.
Thank you, Larry. Thank you for that. Here's our final question of the evening, and it's a question about gifting complex assets, business interest, and the like. Lynn, do you have some insights about this?
Yeah, so, many donors first think, checkbook giving or cash giving as a way to give, but there are so many other ways to give. And both Parker and Larry talked about this, that giving other types of assets, giving appreciated securities. Think about real estate, whether that's your personal home, a vacation home, other types of commercial real estate, farmland, different types of business interests, all can be given to nonprofits. And so some nonprofits, accept all of these types, some don't. But donor advised funds, as Parker was talking about, many of them do accept these types of assets, and even like tangible personal property. So like think artwork or coin collections or things like that. So even if you don't just think about cash giving, think about some complex assets that you may be holding, and maybe you want to consider giving those types of gifts, getting an income tax deduction. So there's ways to do it. Not only giving it to a nonprofit, but maybe giving it to a community foundation or a donor advised fund. There's all these different ways. So definitely connect with, either Josephine or others about giving those types of assets.
Thank you so much, Lynn. Irene, that's all of our questions for this evening. Why don't you wrap us up?
Great. Thank you so much for joining us. We really, really appreciate it. You will receive a link to the recorded webinar in your email. I especially want to thank our experts, so Lynn, Larry, and Parker, for sharing your knowledge with us. And I think one of the, it's oversimplifying it, but sort of make a plan with a longer term focus in mind, right? With these changes in mind, and be flexible, right, to more changes coming, but have those sort of long-term strategies in mind. Stay the course, everyone, and have a wonderful evening. Thank you so much.